Thank you, thank you. We're going to save the UK stock market, and I see the interest is here. We have some interested people, but in the listing of this, there's a dire strait of listings. It says in the UK and slow growth. So, I'd like to start just by allowing the panelists to introduce themselves. Tell us who you're with, and go ahead and tell us your feelings on the UK stock market, if you'd like.
Great. Thanks, everyone. Thanks for joining. So my name's Nicola Higgs. I'm a partner in a law firm called Latham and Watkins. I am based in London. I work predominantly in financial services regulation. And we as a firm, we spend a lot of time taking companies public, both here and in the US. So have some insights on the pipeline for that question of the dire straits of the UK stock market. But equally, as regulatory lawyers, we spend a lot of our time advising companies on the kind of the launch of trading apps and oftentimes looking at what is working elsewhere overseas and then trying to kind of port that and make it work under the UK regulatory framework. So see a lot of the friction that comes out of trying to transpose that sort of retail access mechanism when it lands in the UK market. So happy to touch on that perspective as well. And obviously in that context, we've been very focused on all of the kind of government and regulatory reform around its competitiveness and growth agenda to try and alleviate some of that friction and barriers, both from a cap markets growth perspective, but also a retail access perspective.
Hi, I'm Dan Lane from Robinhood. I'm the investment content lead, so I cover everything education and offer some market analysis and insight into US and UK equities. Um, we're very happy to be in the UK to support the retail investors. We think there's a tremendous opportunity ahead of retail investors, both in the structure of the market and kind of in what they can invest in. There's been a lot of things put in their way over the past few years, which gives us a great opportunity to make things a little bit more, a little bit easier and increase confidence in investing.
Hi everyone, I'm Jack Crone. I am PR and Public Affairs Lead at the investing and trading platform IG. I imagine most of you know who we are. We've been around for around 50 years now. The business has been going through some interesting changes recently in terms of the audience that we're targeting and kind of broadening that base. We currently have around 100,000 UK active clients. We're commission free. And we offer, multiple assets, broad range of assets. In terms of the UK stock market, I think we're in a lot of trouble. Listings have obviously fallen off a cliff in the last decade or so. I think, what we saw in yesterday's budget was, very, very, very small baby steps in the right direction, but I don't think it's going to be enough to move the dial. And I don't think anything we've seen from this government so far will be. So I think we need we need far braver policy if we're going to see the UK market kind of get to where it needs to be.
Great.
Hi everyone, I'm David Belle. I run Fink Money. And for me, it's so important to get British people invested in shares. That is pretty much the underlying ethos of what we do. And I think from that perspective, I'm going to be talking very much from a trader's mindset today. And funnily enough, a trader who only invests in the US market. I don't actually touch the UK apart from Rolls-Royce. So that will be my perspective, and maybe you're going to take quite a negative tone from what I say, unfortunately. So be prepared.
Well, let's get into it. Let's start at the bottom here. Grab the flag, wave it. David just moved to Portugal, so he's certainly letting his feet tell you how he feels. But why? I mean, at some point you must have been interested in UK stocks, or how did you go from being a Briton who's just not interested in capital markets in general to having, it seems like, a disdain for UK equities?
I think, look, so the US market is very much momentum driven, whereas every single piece of research that you hear about UK equities comes from a value perspective. And value over the last 30 years has not necessarily been the best driver of annualized returns from a factor-based perspective. Momentum has been. And that is something that I think is rather perverse with the UK risk mindset. You know, a lot of people in the UK seem to think that just because the market keeps going up, oh no, it's overvalued now. And they'd actually rather buy something that's gone down loads because they think, oh, it's trading at a discount. Whereas my perspective is if something's going down, there's a reason for it to be going down. There has to be a really, really suitable reason to be trading value in this environment. Now, there have been some upsides to value ETFs from the UK over the last 5 years. However, predominantly, if you're able to trade a momentum-based perspective, then that is the way to go. Now, the UK's problem, in my view, is, and this comes top down, so right from macroeconomic policy, from the Treasury, we saw yesterday, there's a massive disincentives crisis. And I think if we take the example of why I like Rolls-Royce so much, they're hugely innovative. They're almost a US firm in the UK, and they exhibit that momentum factor that I really like. However, a lot of UK equities do not show that 5 to 10 year innovation growth phase that you tend to look for something that's going to go up and to the right. And I think that's a fundamental problem with the UK, is it's just not attractive enough from maybe a funding perspective, from maybe a capital markets perspective, maybe construction of the LSE and, you know, incentives there. It's just not an attractive enough place for innovation to thrive, even though we have such highly qualified workforce. And on that point, I think this is why we're also seeing so much US investment come into the UK, because actually they recognize that we've got a massively qualified workforce. They're just not paid enough. And so from a business perspective, it makes sense because operational costs are going to be lower. But I think the overriding point here is that there is a disincentives crisis, and it starts from the top of government. And quite frankly, and I'm going to be very crude here because I don't care, the government are fucking idiots. And everyone knows that. And yesterday's highlighted that even more so. It's sheer incompetence, but this is a structural problem for the last 20 years. It's not just this Labour government, it is structural. And it's going to take a lot of unwinding to get back to where we need to. And I think that definitely has a massive negative hit on investment outcomes.
Okay, well, we just started the bottom there. But there is good news here. I mean, just today, JP Morgan announced they're going to build the biggest building in London, in Canary Wharf, the biggest office tower. I think it's a massive investment just over here. So they see an opportunity here to hire 10,000 people or having 10,000 people in the offices. And Nicola, maybe you can tell us that the government does see this as a problem right now and wants to fix this. And like, what are the steps that are being taken or should be taken to make this a more interesting place to invest or to IPO?
I think there's been a huge focus on it. Whether we've got it quite right yet, and whether we can get it quite right with just sort of regulatory and rules-based reform alone, is probably a bit of a moot discussion. Whether we can get there quickly enough. I will say, just to finish off the discussion on why are things going badly, or why have things historically gone badly. One of the things that we often hear from companies and from CEOs and founders who are pre-listing, and they're considering, you know, is it going to be a London listing? Is it going to be a US listing? There's a positive trajectory in the sense that that is now the conversation back on the table. For, you know, 5 years ago, it was, is it London? Is it Amsterdam? Is it Frankfurt? And so our sort of competition shifted in a different direction. Clearly, like, the conversation leans a lot on the size of the market, the liquidity of the market. And so I think, to your point, when people have got real like momentum in their perspective, they're thinking about US growth and they like the idea of a US listing from that perspective. But it often comes down actually to the perception in the media here. We like to call it the Daily Mail test, but we don't really like celebrate CEOs and founders earning a ton of money. And a lot of CEOs and founders think, I'd quite like, you know, if I'm going to take this business in the next direction, I'm going to grow it. I want it to be enormous. And I don't want to be criticized for taking home whatever X I'm taking as the CEO of that business, who's not, frankly, not going to sleep for the next 10 years trying to get the company there and taking on a lot of personal risk. So that is still the number one reason we hear from both companies, founders, and also the bankers advising them on what's like a fundamental asset test on why people choose the US over the UK. The other one, which is also somewhat outside of the control of policy, but I think links back to what we're trying to do from a policy perspective, relates to indexation. And when you're taking a company public, you want liquidity in your stocks, and you therefore have this dream of being listed on the S&P 500. And that is something of a pipe dream, because you need to be relatively enormous and have a good trading history to kind of get yourself into that bracket. But the idea is you get listed in there, then you are listed in a bunch of passive ETFs, and there's great liquidity in your stocks, and people really like the idea of that. So they like the idea of the US from that perspective. And so, what a lot of the focus on is now is like, can we have subsets of that indexation for UK/European markets so that people can see more access for that kind of passive investment funds into equity? And I think that brings us back to kind of effectively what is the reform agenda. Again, when we think about like where we're trying to get to, and we think about that US market comparator, what do they do differently, which means they've got a much better historic track record of getting retail investors into equity markets. There's the 401k, in the sense that the minute you get your pension, you're used to having a proportion of your family's wealth and assets invested in equity markets. It's far more commonplace than it has been traditionally here for regulatory barrier reasons. There's much more of a common fact pattern in the US for people to have share incentive plans. So almost as part of your employment model, you're much more used to holding equity than the average retail investor has been traditionally in this market. So as a society, they're much more open-minded about equity and the risk of it, and much more kind of understanding it's sort of bred from various angles. But then I think more from a sort of regulatory lawyer's perspective, and what we see day to day is it's far less like friction. There's far less friction in the market infrastructure of marketing to retail investors, setting up your trading app for retail investors, enabling fractional share entitlements so that retail investors can take a slice of something but not necessarily afford the whole of something. That has all been much easier in the US. And I think those areas are really where the government is trying to target reform in the UK to facilitate more retail access here. They're doing it through things like reducing disclosure burdens for retail funds and UCITS, trying to come up with new funds that can sort of passively invest in retail markets more readily. Trying to introduce sort of more innovative ways to give advice, so it could be kind of quick and easy.
Well, let's jump off that with Dan. I mean, you've been on both sides of this. You've been an equity analyst in the UK. You see it at Robinhood. Is there a home bias with traders? Is that something that you can cultivate? Is it worth investing in the UK stock market? I mean, what are people missing? Because it's not all losers. There's a lot of winners in the market as well.
Yeah, I mean, I would agree here that, David, it is a value driven market, and value's been out of favor for a long time. Value is also more difficult because you're having to unearth those stones and trying to find those gems, and it's difficult once the psychology of putting your time and energy into the stock analysis, and then you find out that it's something that you don't want. It's quite difficult. It's also people are time poor. Retail investors aren't these people poring over balance sheets while they're sitting in bed. I did it for a job and I found it difficult.
Well, I think AI can help.
It can, and I mean, we'll come on to it. This is where we see the opportunity here. And if I can go back to kind of, we've talked top down here. What's the case? If I can talk bottom up on behalf of the retail investor, tools are out there that they can make use of, but education is so important right now. And I think some of the work that we do has always fallen short as an industry because we say, here's a couple of articles, off you go. And I think what then people are met with is this wealth of stocks. And we're not allowed to cross that boundary with kind of that advice, guidance frontier there. But I mean, just something that we've done at Robinhood recently is we launched a product called Cortex Digests. It'll in near enough real time digest an earnings call for you and tell you what's been happening. It's not an advisor, but it is giving you the information that you need to make an informed choice. And is that specific term, making an informed choice, which UK investors are finding really difficult.
Okay. Can you jump off on that, Jack? I mean, how do we get more people interested in investing? You know, not every stock market can be the Mag 7 Nasdaq. Not every company can be that. How do you get people interested in sort of the broader universe of investing and get more people involved in investing aside from what's been successful in the last number of years have been like memes, right? And is that the road the UK wants to go down to get retail interested, or should it be something like shares in your own company or or broad ETFs? I mean, and what's the gap between what people want and what they should really be investing in?
I'm going to go back to the government policy point. Just to counter to David a little bit, I don't want to be a supporter of the Labour government, but I think in the cut of the cash ISA yesterday, we saw, a positive step in terms of pushing more people towards investment. I think a lot of people in the last 6 months have had a crystal ball and been able to tell that this is going to have no impact whatsoever on investing. But, from my perspective, I think, something like this is going to be more impactful than an industry ad campaign, which feels like it's for the most part going to reach people who are already invest and preach the converted. So I think policy that genuinely significantly pushes people towards investing. I think it's been talked about over the last 6 months again, but there's a big fear factor in the UK when it comes to investing. The Chancellor in the summer made it one of her goals to address this fear factor. I'm not sure any of the Leeds Reform's policies effectively do that. One of the things she mentioned was this review around risk disclaimers. We did some research recently on that capital is at risk message, which most platforms use, and the majority of non-investors were deterred from investing from that message. Now the FCA would say, we have stated that you don't have to use that message. You can kind of state the pros and cons of investing, but I think that needs to be enshrined in the regulation, because at the moment you've got a situation where platforms are fearful of kind of a misstep when it comes to the FCA and the government, and everyone just defaults to kind of the risk message. So I think we need to enshrine in regulation a risk disclaimer which conveys the pros and cons of investing, and do the same with cash, and just make it abundantly clear to people that investing is a good thing. Because at the moment in the UK, there is just, for anyone who isn't already sold on investing, there's a general kind of fear and reluctance to invest, I would say.
Okay. I mean, tell us what I mean, if there is this real incentive or this real drive to get people investing in the UK, how far could you go? I look at the global landscape right now, and it's sort of the end of the globalization era, and it's becoming more of these domestic focused things. In Canada, they're talking about refocusing the national pension to Canadian equities, right? Is this the sort of, do we need these heavy top down, and even forcing retail investors in their retirements to have a certain allocation to domestic equities? I mean, is this coming? Is this something that we want to happen?
Well, I think it's a very important idea to have on the table, to be honest, because if you think about the average equity offering and how that starts in the primary market, it's just easier to allocate that to institutional investor books, because they'll take a bigger slug of the trade and you get higher transaction commission volumes for doing that. There's no incentive, financial or mandatory or otherwise, which kind of encourages the banks in charge of that primary offering to find a retail allocation. And then therefore, retail, there's an argument to say by the time it hits the retail allocation, it's more costly because of transaction tax and everything else. So the value proposition for retail dissipates the more the longer that process takes. And we've certainly worked in a number of jurisdictions where if you're doing something for an issuer of that country, Greek's a good example, then you have to have a mandatory allocation into Greek retail markets through their sort of obvious.
Is that something you think is going to happen?
There's no mention of it happening.
No,
in the
exactly.
UK.
Okay, but I
Yeah.
think maybe that's the way the wind is blowing. And another one along those same lines, David, you trade U.S. stocks, right? And the world has sort of given the American SEC really jurisdiction over everywhere. Because if a UK investor can have in his pension or Canadian U.S. stocks, then you allow the U.S. regulator to decide what's suitable, right? And at one point in time, it was public equities. Then it became ETFs, then it became leveraged ETFs, and then options, and now crypto even. Is there a risk, or is there a reasonable pushback, at least on suitability even for retail, to maybe back off on some of these things? I mean, we see, and we were just talking about education, and retail makes a lot of bad decisions, and I think governments, is there an argument for them to say, hey, listen, the U.S. has sort of abdicated its responsibility around regulating some of these products, or should it just be a free-for-all?
I think it comes down to liquidity. I think you'd mentioned liquidity already. liquidity is always going to be your safety. And no matter which asset you look at in the US, it's pretty much more liquid there than anywhere else in the world, whether it's in equities, crypto, doesn't matter. Their venues are just so much more liquid. And this is not just because it's just happened to be like that. It's because they've spent and had the will to develop their exchanges better, to actually compete with different market makers. And market makers are willing to compete on such small time frames, invest a shitload of money. Whereas we're just not necessarily willing to do that. Now, one of the biggest issues of the UK market, I think, is that there is no real money bid. So I think pension funds in the UK have an allocation of maybe, I think in some markets, 2 to 7%. If you take Australia, they've got something like a 40 to 45% allocation to domestic Australian equities. But this goes out further because if you look at UK infrastructure, we don't own any of our airports. Whereas in the US, there is a rule which says that only 20% can be owned by foreign entities. In the UK, I think Heathrow is owned by Qatar, the Australian pension fund, or one of the biggest superannuation funds there. I think it's owned by the Singaporean pension fund and also Abu Dhabi or PIF. Now, if we take that context from an incentives perspective top down, we can then start seeing the problems. Okay, we're willing to asset strip and we're not willing to invest in our own economy with our own funds. And this is largely the problem as to why UK equities don't have that primary bid or real money bid, because we're just not willing to do it for whatever reason. Now, I have a broader thing and a broader issue with the UK retail landscape across investing. And I like to call it the Martin Lewisification of the UK. Now, this is where Martin Lewis has told so many people to go and save 50 quid on your energy bills per year, rather than saying to people, here's possibly some research on a company, or here is the primary thing you should do to actually grow your wealth. It's a scrimpers and savers mentality that the UK has, whereas in the US, what people are willing to do is just go and punt 5 grand on a stock and hopefully make money. It's a completely different environment, but a lot of people in the UK seem to think like it. And one thing that I'll finish on is even my parents, they ask me today, are you saving your money? They've never touched equities before. And I'm like, Mum, I literally trade for a living. Do you not understand? And it's like, it's just a completely different mentality, I think. And that is largely one of the biggest issues.
UK is a gambling. I mean, there's a lot of gambling in sports that happens here. So there is this ability to take risk, and it just hasn't gone in to the stock market the same as elsewhere. But let's say, let me ask Dan. You know the universe of UK equities. Let's say this pendulum does swing. We do get this more of a home bias. We get some of these cultural changes, and we get pensions forced to allocate 40% to the UK. I mean, how can brokers sort of help people get into this market ahead of that, or how can they facilitate that? I mean, there's this huge temptation for all brokers to be like, you can trade Tesla shares here, you can trade leverage Tesla shares, you can trade options or whatever Mag 7 stock it is. How can we redirect people towards the local market without hammering them over the head about value or balance sheets? Because I think it should work, but it doesn't.
Yeah, you're right. It's hitting people with the most complicated end of the stick just doesn't work. It starts before they even enter the brokerage platform. I mean, there's a couple here, but it starts before that. A lot of it is to do with perceptions, and we did a piece of work called Freedom to Invest. We did a survey in June to try and really test some of the assumptions that we have about the industry, about things that we all tend to say, women don't take risk, all these types of things that everyone said for 20 years, but there's no proof of. One of the things that came out is the cost. People in our survey thought that you needed around 2 or 3 grand to open an ISA. You don't. You can get going with an investment account with us with $1. But there's a bigger psyche there. It's the people. It's not for people like me. That's what the whole thing is in retail. Even the term retail investors do not know that they are retail investors. Didn't understand the term. So, everyday investors is a little way that we can start talking about them. The confidence gap is crazy. There is, as David said, sometimes there's a bit of an overconfidence gap in the US. But whenever you've got momentum playing in your favor, sometimes that helps until it doesn't. The confidence really needs built up. and this comes with education, but not in an encyclopedia and not in a, hey, there's a web page there, go and read it. It comes at every point of your journey, before you're investing, while you're investing. Something that we do is offer nursery communications in your first 6 weeks that you'll get a lot of hand-holding. Hey, do you know what this is? Here's this site. What does it actually mean to be rich? What are you actually going for? As well as these kind of AI-driven tools that we have that won't make the decision for you, but will help you feel more informed. Another part of that is the jargon. The way that we write is as if we're talking to our friends.
Well, how do you bring that back to the UK market, though, and say, is that home bias? I don't know if it's that strong in the UK. Will you be nudged at some points by brokers to say, hey, or say they make the rules?
Well,
Local clients have to have 30% invested. I mean, there is a world out there where this happens. And do we want to build the tools? Do we want to have the people that can say, hey, listen, if you have to have an allocation in the UK, maybe it's an ETF, maybe it's individual names you want to look at.
I mean, there was some report. Mintel did some research into intentions of what people would do when the ISA, before the ISA allowance was changed yesterday on cash ISAs, and people said that they would be willing to go more into stocks and shares. Again, though, this is all very top down. A retail investor with no knowledge of the space is only going to get confused by more changes. And the way we talk about the industry is as if people understand what the FTSE is, and they're just not quite there. It is the level of understanding is so much lower than that.
Right.
So whether we're tinkering around with allowances or not, the very basics of understanding what investing is where we need to start. This is why financial education in schools is so important. I was a teacher in an earlier life, and the only thing that we had time for was to talk about pounds and gas meters. That was the tick on the financial
It's really
inclusion.
ghastly that we don't have finance, and almost every country has the same problem.
Yeah. But that's where
there seems to be a consensus. It needs to be better, but nobody seems to be doing it that well. And instead, they get their education from TikTok. But Jack, how can we get people more interested in investing in young people and investing, not just trading? It seems everybody starts out as a trader. How do you get them quicker to?
Yeah, I think it's worth again acknowledging that point that I made earlier, which is younger people are more interested in investing than the previous generations. There's no question about that. That's happening, and that's through better access to investments, cheaper investments, technology. So I think it's already happening. But I think just going back to the US UK comparison, all of our best companies get sold to US private equity, or they go and list in the US. And you've got a situation where our most exciting tech stock in the FTSE 100 is Sage. And I don't think most people have heard of them or have any idea what they do. So it's, in the US, they've got these great stories and narratives and CEOs, and it's something that they buy into, and it's almost cult-like. Whereas, what's there to get behind over here? It's like, if you're not unless you've got an obsession with mining stocks and big,
they've done pretty well.
And yeah, this year they've done very well, and big oil, then it's, we don't have that. And that's obviously a structural issue which has many facets to it in terms of how you keep these companies here, and not kind of encourage them not to sell out, and whether it's government support. But I think national heroes national kind of stock heroes is something we need, and I think people do have a tendency to get behind companies that are local to them and that feel kind of like they're kind of national heroes. I did some research at a previous company I was at, which I won't mention because the MD's here, and I don't want to PR them, but where we found that generally people in cities around the UK were far more likely to invest in their local companies, their local headquartered companies, than they were in other companies around the UK. And you had situations where investors in Newcastle were twice as likely to buy Greggs than they were around the UK. I think that will extrapolate on a national level, except we just don't have the exciting companies to get people into it. So I think that's somewhere to start, but I don't have the solution.
Well, is there any in the pipeline? Is that are you optimistic about the pipeline of IPOs?
So we have a lot of IPOs in the pipeline that will decide. They'll prep for an IPO for 12 months, and they'll be 12 months out from IPO, and they'll decide on their listing venue. And those companies are, UK headquartered multinational companies or European headquartered multinational companies that are very firmly watching London and watching New York, and then trying to figure out the right point in time which listing venue they're going to go for, being heavily courted by the senior ranks of government to be encouraged to encouraged to list in London. But I do think it comes back to the point around momentum always. They fundamentally got to say, where is our growth as a company in the next 10 years, and where are we going to get most liquidity for our stocks in the next 10 years? And it does seem to be always the case that you sort of tip to New York when that's the question at the front.
That's the thing about liquidity, like David said. Like the problem with liquidity, if you're always chasing liquidity, you're always going to be there. There's no stopping it. I mean, the tech bull market won't last forever. The U.S. stock market has a lot of long periods that have been really rough, and value comes back into focus. And you're going to have a hard time getting a higher multiple anywhere than the U.S., where you have companies trading at 50 times revenue. And that's so seductive for anyone in a technology company who's thinking about doing an IPO. But I'll come back to you, David, and I hope you have a little bit of optimism still. Can we save the UK stock market?
I think yes, but I think on a point that Jack mentioned is with regards to, championing exciting UK companies. I think what Rolls-Royce is doing is possibly one of the most exciting and revolutionary things that could possibly happen. And yet the UK government put the contract for the small modular reactors up for tender to Rolls-Royce and 3 other foreign companies. Now, my view is that they should have just done maybe what Trump would probably do and just say, you've got the contract, because it's a British company. There is no reason for GE Hitachi to be involved, no reason for the other 2 American companies to be involved. And then you do a massive PR campaign shouting about Rolls-Royce, which has done 950% in the last 4 years, by the way, possibly the best performing large cap stock on the FTSE, purely British, but no one knows about it. No one knows the CEO's name, who basically turned the company around. Yet in the US, you know about Musk, you know about Jensen Huang, you know about Ellison, you know about all of these different CEOs. And yet I don't think there's anyone that could tell me one FTSE listed CEO's name, maybe, if you were to ask them in the street. There is not one, yet everyone would know about Elon Musk. Why is that?
I mean, those are all great points, but it does sound like an opportunity. I mean, you have a stock that's doing really well. There are good companies in the UK. I mean, does anyone have any views on, how else we save the stock market in the UK besides having, really good companies?
I would say, sorry to cut you there, because I know we've only got 7 minutes. So I would say from a company level, they have to be more comfortable with the CEO taking more equity. In the US, the average CEO has between 0.75 and 1% of the shares outstanding, which provides a massive, massive incentive to actually increase the share price, which translates to, they're looking for more profitability. In the UK, the average CEO has about 0.05% to 0.2% of the shares.
That's very annoying when CEOs have or the board or everyone has no stake. But you did mention earlier, and I want to ask the brokers about this, about liquidity. And, from my perspective on the retail side, I don't mind as long as the liquidity is enough for me to get in and out. I mean, I'm not slinging $1 billion in and out of a stock. So yeah, you might pay a little bit wider spread, but you can get tremendous value. And is there, on the broker side, is there anything that can be done to sort of maybe educate people? Or I don't know if they need to be warned as much about the liquidity, but also told that, listen, there are value plays here that you can get in and out of that hedge funds aren't interested in. They won't touch anything with a market cap under 3 billion or $1 billion. And maybe we should have more education on the broad. Maybe you can speak about that.
Yeah, exactly. I mean, we tend to talk about mid and small caps the same that we talk about them in the US. They're not mid and small caps to us in the US. You look at something like a Yeti that'll make your favorite flask in the US. The market cap is in the 3 or 4 billion, something like that. That's a mid cap over there. It's not the same over here. We need to be championing what actually mid and small means in the UK. 50% domestic revenues. You've still got that that international revenue stream. but you're getting a lot of things from the company that you will look at and buy from, and have their experiences, have their services. But do we know that when you use their services that you could buy their stock? I don't think people still make that link. I don't think we do that, especially when it comes down into the smaller cap. When you look at new retail investors, liquidity doesn't come into their heads. It only becomes when you start to see the charts and maybe their trades aren't going through as quickly as they'd like. But actually, for the perception of, do I want to buy UK and can I buy UK, that's the part that we need to make.
You don't even know they're listed at all.
Just
Right.
just to add on to that as well, though, in the UK you pay 50 basis points of stamp duty. In the US you don't. So there's that liquidity element, but then also the fact that your cost is right up straight away the second you buy it,
Right. We got to get costs down to.
which makes no sense. Why you charge tax on UK equities but not on US equities?
Just
Yeah.
on that note as well, obviously everyone knows the FTSE 100 is a dividend stock market, and when the government is raising taxes on dividends over and over and over again, and
Windfall taxes too on oil and gas at $55 a.
yeah, it's investors back in the UK need a kind of a level that they need some stability, and they need to understand what taxes they're paying, and by continuing to raise taxes on dividends, we're taking away our trump card for in terms of global markets, which has been like a global dividend stronghold, particularly for US and for UK investors anyway. So
Well, I mean, there's a tremendous amount of wealth in the UK, right? And if you could keep it in the UK, that alone can snowball, right? Do you have any final thoughts on? I mean, the optimist here on saving the UK stock market. Can we do it?
Well, I think the topic of education has come up, and I think it probably is key. And I think that's probably where I think the government and the regulators and the FCA more specifically need to kind of step up and be a lot braver than they've been. They've really encouraged people to think about education on like risk more pragmatically, and not have these scary kind of risk warnings, but have actual sort of an explanation of how things go up and down. But they've given no guidance to the industry on how they feel you can market the positive impact of investing in equities, notwithstanding they're out there saying we're doing everything we can on competitiveness and growth to encourage it and to take away the friction. Well, actually, how about just present, help firms understand how to present a positive mentality on this trading? Because at the same time, we have, criminal trials in the UK for the finfluencers who have been engaged on social media to promote trading. So we need to bridge that gap and bridge it quickly.
Right. And anything on what's working on the retail side, guys, in that sort of education level? What's resonating? What actually gets people to invest locally?
Yeah, meeting people where they are, not asking people to change anything. It's about habit hacking, I guess. Something that people are doing already. Something that we've done is we sponsor 100 pub quizzes around the UK. People are having pub quizzes, a few questions here and there, and a few introductions. This doesn't have to be a heavy topic that you sit down with someone like me in a suit and tie. It's something to bring into your everyday life, and that's the tone that we take, the products that we offer, and how we meet people in emails, pushes, and events.
I think education has been evolving a lot in the last few years, and it's moved on to social, and it's I think there's a lot out there for people who want it. I think if looking across the kind of the podcast world, there's probably too much kind of basic entry level podcasts often presented by journalists. And I think it would be good to kind of bring some of the experts more into that social world, and who can bring their expertise into that realm in an entertaining way. We've had a podcast, a very new podcast at IG, which has been going for a couple of months, called The Art of Investing, where we have two former hedge fund managers who talk about how it's the whole podcast is them building a portfolio, and each week they go through every asset class and they explain why it's in the portfolio and the function it has, and they change the portfolio each week, and they talk through their decisions, and we need to move beyond that very, very entry level, like this is what the FTSE is, this is what a dividend is, and kind of enrich that offering, I think, on education.
Okay. Any final thoughts, David, on how we can save this? You've seen education on all sides. You've seen retail struggle. You've seen retail succeed too. And can we get them excited about local companies?
I think for many people, it is literally just taking the first step along the risk curve and recognizing that they have to.
Just
There's
get more people in the UK making that first trade, right?
Yeah.
With its $1 in a Robinhood account
I mean,
or an IG
one
account. or
one
whatever.
thing that works really well with what I do is making people understand the foundation of why they have to take risk on more. For younger people, they're not going to be able to afford a house, where traditionally people that bought in the 70s, 80s have, experienced massive gains, who might not have had to be invested in the stock market because they had that security of bricks and mortar, perhaps. Whereas these days, people need to be invested. It's not even an optionality anymore. It's literally just you have to be invested. Otherwise, your future is pretty much going to be very, very dark.
I think the young people are receptive to the
Yeah.
idea of investing now, and it's easier than ever with apps, with low fees, low account balances you need. So hopefully we can all wave the flag here at some point and say, the UK. I mean, international equities have done well, and I think the UK can do well as well. And like you said, a lot of talented people. There does seem to be a will from the government right now to turn this around, and we have great companies that make it easy to invest in the UK. So hopefully we accomplished something today. Thanks for listening, and
Thank you.
that wraps us up for this panel. Thanks to our panelists.